What I want to talk about today is funding a whole life insurance policy and the different ways that you can do it. Because when it comes to funding a whole life insurance policy, this can often be an area that stops people from even considering a policy. There's typically two main reasons why. When it comes to funding a whole life insurance policy, what people do not want is, number one, they do not want to be obligated or committed to paying a large premium every single year. And then number two, people typically don't want to have to pay premiums for their whole life. When you hear the word whole life insurance, how long do you think that you have to pay premiums? It's very common for an individual to assume, well, I thought you had to pay it for your whole life. That's the name of the product, right? You don't have to do that at all, I promise. So we're going to look at some examples today, or I should say we're going to discuss some examples, and we're going to talk about really what a lot of people we work with, what they like to do with their policies with respect to funding them and how we set them up. So when we look at the cash value benefits, this is often what attracts people to a whole life insurance. They're taking the policy out because they want to maximize the cash value and then be able to use the cash value. And when we look at the cash value core benefits, it is safe, liquid, and tax-free. Tax-free if we do not trigger a taxable event, one of which is a MEC, which stands for Modified Endowment Contract. We'll talk about that a little bit more later in this video. But when it comes to money going into a whole life insurance policy, so this specifically is your money going into a policy. Pretend this is you. Here's the questions I would ask, or I should say the questions I would encourage you to ask yourself. How much and how long? Meaning, how much do you want to fund your policy with, and how long would you like to fund the policy for? Now, the first question, I would phrase it a little bit differently. I would actually ask it like this. How much do you want the ability to add into a policy on any given year? Because if we go back to that first objection, which is where people often stop and say, I'm not interested in whole life insurance because I don't want to, what was the first objection? I don't want to have to pay a huge premium every year. I don't want to be committed to this big bill. So going to back to this question, how much do you want the ability to fund a policy with every single year? Well, we can set a policy up to be very flexible. I'll give you a quick example. We've got the first two down here, $100,000 per year, and then $100,000 per year with minimum commitment. So what's cool about this is this could be the exact same policy for the exact same individual. We can set the policy up in a manner where A, we're paying $100K per year, and that's the dollar amount an insurance company bills us for every single year. So I'm billed for $100,000, and we can set it up for maximum cash value, but every year, when I get that statement and billing notice from the insurance company, I've got $100,000 per year. The second example, we see $100 per year, but with minimum commitment. Well, what's that mean? Well, what that means is we can set it up where we are only billed for about $10,000 per year. But then at the same time, I can add more money into the policy at leisure up to a total of $100,000. So that'd be another 90 because my premium does count toward the 100. But my point is, I'm billed for 100 and I can add up to 90K per year, but I don't have to do that either. So now all of a sudden what I've done is taken a whole life insurance policy designed for maximum cash value and made it very flexible, where I know I can hit 100K, but I don't want to be committed to that every year. It kind of feels like a burden to me. But hey, if I could commit just to $10,000 per year, that would not feel like a burden at all. And this is true regardless of the dollar amount you're looking at. If it's a maximum of $50,000 per year, guess where the minimum premium could be? Close to about $5,000 per year. If you're looking at $1 million per year, guess where the minimum premium would be? About $100,000 per year. So often we can drive that minimum premium as low as 10% with some of the top major mutual companies, your big four, and some smaller companies will also allow this. Some actually even let you go lower than this 10% minimum. But my point is, how much do you want the ability, put that word there, to add to a policy on any given year? If it's $100K per year, now we know we can design the policy with a very low premium, so you can commit just to $10K per year. The second question, how long? how long do you want to pay into the policy? And the most common answer I receive when I ask someone this question is this: I don't know, which is perfectly fine, by the way, but we don't know how long we want to pay into it. However, what I do typically see is one states, I know I can pay into it, or I know I want to pay into it for at least 5 years, at least 10 years. After that, I'm not quite sure I want to keep on paying into this policy. I might want to just let the cash value grow and then use it, accessing it like a line of credit, but I don't know that I want to pay forever. But I might want to pay forever. So that does have to do more with the product and the agent that designs the policy, but guidance on this certainly does help. For example, it's very common for individuals to state, here's how long I want to pay into it. Or I've got a lump sum of money, say it's $1 million, how many years should I move that money into the policy? So with a lump sum, if you've got $1 million, what makes the most sense? I remember years ago, I would get the question a lot, hey, can I just throw this full $1 million into a policy, whatever lump sum the individual is dealing with? The company's paying a dividend rate of 6%. And if I just throw $1 million in, it starts to earn that 6% dividend right away, correct? Not quite, unfortunately. One, we can look at how dividends work, but two, we've got a life insurance product. And no matter what happens, we've got a premium that's due at least through the 7th policy year. So if I just throw a lump sum into a policy and I pay nothing beginning year 2, well, that premium has to be paid from somewhere. It's paid from the policy, which is going to drag on the performance. So let me answer the question by asking a question. If this is you want to throw $1 million into a policy, and we're going to look at the same company, same product, everything's identical here, and I'm going to give you 3 options and say, which one do you think provides the best overall value? We've got option A, you're going to move that $1 million into a policy in one year, a one-time lump sum. Option B, $250K for 4 years, total of $1 million. Or option C, $100K per year for 10 years. Again, same company, same product, everything's identical with the exception of how we move that money into a policy. Well, this option would produce the greatest results. And we've got videos that provide a thorough breakdown on lump sum payment and exactly how that works. But a lump sum there, going back to the question, how long do I want to pay into it? Well, it's going to be a shorter period of time. And you might answer the question by saying, I've got a lump sum of money, tell me what to do, or show me the best option. And then we would do exactly that. Or you might want to be able to pay forever, or stop at age 65 perhaps. There's many different ways you can set up a policy with respect to the funding period. So let's take a look at actually funding a policy and what that looks like with respect to the mechanics. So when I have a whole life insurance policy, let's say I'm this individual down here. I want to be able to pay up to $100,000 per year, but I don't want to be billed for that. I do not want this policy to feel like a burden. I really like the benefits that come with cash value life insurance, but man, if I'm obligated to this $100K per year, I'm just going to be thinking about it all the time and I'm going to be stressed out over nothing. Like, I don't want that. Not to worry, we can make it very flexible. So of that $100,000, did you know we can actually choose where that money goes? We can elect for it to go toward the base premium or the PUA rider. Base premium dollars, if I have 10% here, which with those 4 major mutual companies is often as low as I can drive the base premium. Sometimes you can go lower, depending on the company and such. But let's say it's 10% in this example, $10,000 base premium. Premium dollars with a traditional whole life insurance policy typically do not build cash value in the first year. Sometimes it's the first and second year. What's important to note is premium dollars do build cash value over time. So if it's a traditional whole life insurance policy, when I say traditional whole life insurance, I'm referring to a policy that is called a whole life 100, or paid up at 100, or paid up at 121. So a whole life 100 means that the premiums are payable up until age 100, and that's the most commonly type of life insurance policy that is sold. a whole life 100, a traditional type of product. And those products typically do not build any cash value from premium dollars in the first and second year. But in the third year, I would see the majority of that $10,000 come back to cash value, start to compound, and get better and better from that point forward. But the reason they do not show up in cash value initially, premium dollars that is because the company is going to overcharge me for a death benefit up front. Let's say the death benefit is $500,000. Let's make that a bit smaller. So $500K death benefit. And if I stop there and say, I don't care about the death benefit, I'm interested in the cash value, which is a response we often hear. What's important about the death benefit is that it has a direct relationship to that MEC limit. MEC is that modified endowment contract limit. And in this example, 500K death benefit will get you approximately $25,000 in MEC space. We'll pretend this is a 40-year-old individual. So I want to pay in 100K per year up here. I've got a base premium of $10,000. I want to keep that premium low because it does not give me cash value initially. But I've got this MEC limit, which is that taxable line. If I pay more than that MEC limit into my policy, it becomes classified as a modified endowment contract. Then the cash value grows tax deferred. Anything I access, I've got to pay ordinary income tax on the gains, plus a potential 10% penalty tax. I don't want that MEC to occur. Like, no, prevent it, please. So where I'm at right now, how much could I add to my PUA rider? Could I add another 90% of my desired payment? No. I could add another $15,000 because my MEC limit's 25K. So what I need to do is raise my MEC limit to prevent this taxable event. This aligns with a third core benefit of the product, tax-free, the cash value that is. So there's two ways you can do that. One, you can increase your premium. Most people don't want to do that because it forces the minimum commitment higher. Remember, purpose of this is to make it very flexible. I want flexible funding so the policy does not feel like a burden. So what we can do then is this guy. We can add a term insurance rider to the policy. Let's say it's $1,000. That term rider does not build cash value. However, that term rider does buy us life insurance of another $1.5 million. A term insurance rider is a very cheap way, if you don't like the word cheap, a cost-effective way to add more life insurance to your policy, which does what? Adds more MEC space to the policy. So now we've added another $75,000 of MEC space. When you add those two MEC limits together, because you've got the $500,000 whole life death benefit plus the $1.5 million term insurance rider, all part of the same whole life insurance death benefit, what's your MEC limit? $100,000. So now what I can do is commit to $11,000 per year. And a lot of times we'll set it up where $10,000 is a combination of both the base premium and term rider. It does depend on the company. But now, if my minimum's $11,000 here, I can just throw another $89,000 into the policy at discretion, which will really maximize the cash value. And there's more to this. I would check out our video on how to maximize the cash value of a life insurance policy to go through a full breakdown in this piece. But my point is this. When it comes to funding a whole life insurance policy, what people don't want is to be committed to a large bill. What people don't want is to be committed to making premium payments for a long period of time. So what we'll often see is a case like this, where one is committed to $10,000 per year, or an amount they know they can handle no problem, and then they'll add more money into the policy at their discretion of $100,000. And then what you can also do very, very easily is stop after a short period of time. Because if you max fund a policy by throwing more money into the PUA component, you put yourself in a position where if life happens and you can't pay, or if you just want to stop altogether, you can do that no problem. We'll often see individuals say, okay, I want to go with this design, but then after 5 years, I've gotten a total of 500 grand into the policy, and I'm good. I don't have to pay anything else in. Can I just stop? The answer is yes. And here's what it looks like if you stop based on the guaranteed values, and here's what it looks like if you stop based on the non-guaranteed values, and here's what actually happens when we track your performance year over year as we continue to do that. Point though, is when it comes to funding a whole life insurance policy, you do not need to be committed to a large bill, and you do not have to pay premiums for a very long period of time. You can do either of those if you want to, but at the same time, we can make it flexible, and now all of a sudden we have less stress and can really use the policy to the full. So I hope you enjoyed this video. Let us know if you have any questions, please leave them below. And as always, I hope this helps. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.